Hello, Eric. How are you?
Hey, Ed, I'm good. How you doing?
Good, good. We got a nice audience. Thank you all for joining us. Lots of things to talk about. So this session will last 24 hours. Just stay tuned with us. Anyways, Max isn't going to stay around. He's already taken his snooze. Eric, how's things by you in Santa Monica?
It's all good. Nothing
Yeah,
to complain
cool.
about.
Good, good. I'm glad the fires are all out, right?
Yeah, I think so.
Yeah, yeah, good, good. All right. Yeah, we got a nice day here. It's around 50 degrees, so spring is in the air. We're kind of looking forward to the end of the winter, but the winter wasn't really too bad, so we can't really complain. Lots to talk about, Eric. I guess the markets got spooked on Thursday and Friday. Thursday was Walmart. What did you think about how scary that was?
Yeah, I really didn't feel like, I think it was a lot of consumer worries coalescing together at once, but
Right.
Walmart's guidance wasn't all that bad. They tend to guide kind of lower anyway, but they had some weird one-off adjustments. They had a currency impact, etc. But it mostly seemed like they were trying to just get ahead of any potential tariffs, but didn't seem too
Yeah.
worried.
Well, the other thing is, it is an example of the stretched valuation of this market.
Hmm.
Got a 38 forward PE, or at least it had that on Wednesday of last week. But I think you're right. People are nervous about the consumer, and so it doesn't take much to kind of scare them on that in that regard. Then on Friday, I guess we had more excitement.
Yeah, the rough Michigan consumer sentiment print, I guess, spooked some people, but I don't know why that survey gets much attention anymore. It's completely partisan, right? And
Yeah.
they moved to online surveys. I don't really see the value in it. But again, I think you had the Walmart, you had consumer sentiment, then we had the weak S&P services PMI.
Yeah.
So yeah, it was a lot of things at once, but kind of all things on
Yeah.
the margins on their
Well,
own.
it's actually if we had to make a list of indicators that we think can be funky at times, I think the S&P 500 uh, services index would be one of them. And then, of course, a couple of weeks ago, we had retail sales come out, and that was down 0.9%. That's probably what got everybody
Yeah.
first concerned about the consumer. And of course, adjusting for rising goods prices, that didn't help matters. The real decline was even more. And so you put it all together, and the, uh, there's certainly something to worry about the consumer, but we're sticking with them. I mean, we watch initial unemployment claims. We think that's a pretty good data. Then we've been watching the weekly Red Book indicator of retail sales. That's up like over 5% on a year-over-year basis. And then we're kind of expecting that the NMPMI, the services component of the Institute for Supply Management, we're kind of thinking that that is also going to be better than what the S&P global index was. Now, today we got another funky day. Market looked like it was going to be up, and then it opened and it was down a bit. Maybe it's just kind of floating around with that 50-day moving average for the S&P 500. But we had some mixed signals here. There's some uh, chatter out there. I think one of the brokerage firms said that Microsoft is canceling leases on a couple of data centers. So that looks like that whacked Microsoft, though. I mean, the market's got to like make up its mind. I mean, do we want Microsoft and the others to spend a fortune on AI infrastructure or not? If it turns out that they can produce AI large language models a lot cheaper with a lot less infrastructure, a lot less electricity, why isn't that good for them as well? I guess the idea is it's sort of a monopoly situation. If you got to spend a lot of money and you have the money and nobody else has the money, then you get a monopoly in that technology. But I think it's all good to have AI turn out to be cheaper to produce and to be more powerful. And then to have all this competition of creating large language models is ultimately good for consumers. And all these companies, these larger companies, can certainly and already are incorporating AI into the products that they have now. So just another feature that makes their products more sellable, more interesting for the consumer. So I don't really have a problem with that. And meanwhile, Apple comes out and says they're going to spend $500 billion on AI server facility in Houston, Texas. So, I guess the market's kind of confused about where this is all going, but we think it's on balance. It's a positive for the economy. It's a positive for keeping inflation down. It's a positive for the roaring 2020 scenario. Got anything to add to any of that, Eric?
No, yeah, I just think like, a quick channel check from one sell side bank doesn't warrant much. And I think even if it is true, which it could be, I don't think Microsoft's overall CapEx on AI goes down. It just probably shifts elsewhere or they can put it into newer opportunities. So yeah, I
Sure.
think things look things look okay still on that front.
Right. So I suppose everybody's kind of nervous here after it was not a pleasant couple of days last at the end of last week. We'll see how this one pans out. And then of course there's Washington. You're doing some work on trying to get some data on what Doge is actually accomplishing. You'll do that for tomorrow's morning briefing. You want to give us a little hint of what you're finding?
Yeah, so I think broadly we think, that Trump 2.0 are doing meaningful things. And there were a couple executive orders actually late last week that seem to do a lot in terms of countering China on trade and getting the EU to back off from regulating our tech companies so much. But in terms of Doge being like this big fiscal spend cutter, it doesn't appear to be doing that. Their stated savings are like $55 billion, and yet the total contracts they posted on their wall, so to speak, add up to less than 10 billion. And who knows, like I can cut spending, right, by not paying my mortgage, but that doesn't that's not like an actual good
Yeah.
thing, right? So I know that the journal did some pretty good work. And like for instance, one of the contracts they found that was canceled was $250 million, but it was to modernize the Social Security Administration's technology, which is like one of those things you'd think would actually help cut costs over the long run. So
Sure.
I don't know. I mean, going contract by contract is a tough way to balance the budget. You probably need more of an economic rewiring, which I think this administration is doing. And they're off to a good start, but it's not easy to just go line item by line item and use AI to find savings here and there. So I don't know. Doge is kind of
Mhm.
it's fun and interesting to talk about, but is that going to solve the $1.8 trillion budget deficit? I don't think there's
Yeah, I think you're right about that. And at some point, some hard decisions are going to have to be made about getting more revenues. And certainly, if you're going to cut taxes, you got to come up with other revenues. And
yeah.
I think they're kind of flailing around trying to figure out, where they can find these things. But meanwhile, the bond market seems to be giving them, I think they bought some time with the bond market to the extent
Yeah.
that they're at least focusing on the issue. They're just not willy-nilly saying that they're going to up outlays dramatically. In this case, of course, they're talking about extending the tax cuts, which are, it's a trillion here, a trillion there. It adds up to some serious money. But meanwhile, correct me if I'm wrong, people are stepping up to the plate for the auctions. The auctions haven't been particularly messy. And then tell us a little bit about Scott Bessent. Do you get a little sense of Janet Yellen deja vu all over again?
Yeah, he doesn't want to, or he doesn't plan to, term out the debt in terms of, lessening bills as a percentage of the overall load and not issuing as much. Basically, he's not going to increase coupons, the auction sizes for coupons, so notes and bonds, which I think makes sense. I think it's fine. He was a critic of the strategy that Yellen used, which was to flood the market with bills, but bills are already coming down as a percentage of the overall issuance. We're issuing more notes. And I think over the long run, their goal is to just not, not restart what Yellen did. But I think for now, they just don't want to upset the bond market. It would probably hamper their progress more than it would help at the current moment. So these are these are market participants now running the Treasury and advising Trump on the economy. So I think first and foremost they're concerned about not letting markets get a rein on what they're trying to do.
And what else do we know about Besant? He also seems to be, fairly cautious in terms of doing anything radical. So, how about the Fed? I think we've been talking about the possibility that the Fed will end quantitative tightening sooner rather than later.
Yeah, in the minutes, it said with the debt ceiling issue, there's reserve balances in the banking system can kind of be much more volatile.
Sure.
And the Treasury's general account gets used basically to fill the gap because the government can't issue actually more debt. So they said they might pause QT for a little bit. Honestly, there's a good chance if they pause it, they would just leave it on pause forever and not restart it. I think the Fed is looking for excuses to end it. They don't want to deal with any mishaps in market functioning or the repo market goes out of control and all of a sudden financial markets across the board are down and in pain. So I think it's a Fed that's sensitive to market functioning first and foremost. They'll ease first, ask questions later. But I mean, in terms of bonds and stocks, kind of as a corollary, it's a positive. It's good for asset prices. Removes a little bit of pressure from duration.
Well, it would be nice to believe that the bond yield is just going to stay here for a while. Our target has been 4.5 plus minus 25 basis points. We're a little bit below that target range. But then again, this issue of the supply of debt and the budget will be coming to the fore right around mid-March when it's time to get this their budget act together in Washington, and that may be a pretty sloppy situation. So we'll see how that plays out. Eric, I'm going to go to the charts now, unless you have anything else you wanted to add.
Sounds good.
Okay, good. So we have one question, and so if some of you others would like to chime in, so we'll save some time for Q&A. So let's share some charts here. Yeah, so we kind of looked at the latest worry list. Seems like just in a matter of a couple of days, the market suddenly focused on everything that might go wrong. This is just the market sell-off at the end of last week. We went down to the 50-day moving average. Maybe we're going to toy around with that. Kind of doubt we're going to go down to the 200-day moving average. I guess much will depend on NVIDIA on Wednesday in the afternoon, after the close. And our guess, that's all it is, not even educated, just our guess is that NVIDIA's earnings will be better than expected. But then the question is, what will the guidance be on Blackwell? Blackwell is the super duper chip that was introduced a year ago, and yet they haven't delivered it yet. So we'll see where that goes. Elon Musk apparently bought 200,000 of the cheaper GPU chips and clustered them together and claims that he's got a better LLM, large language model, than DeepSeek or OpenAI or so on. So there's a lot of competition going on in this marketplace. And I think it's pretty exciting. And we're using a very primitive version of AI. We're using Copilot, Microsoft Copilot as a research assistant, and it's pretty handy, actually. So what do we? Let me just hang that up. Okay, so let's look at the some of the other issues here. We've had this pickup in animal spirits, as you can see. This is the NFIB Small Business Survey, the outlook for general business conditions. So Trump gets elected, we get this big spike in animal spirits, as indicated by this series in the survey, kind of reminiscent of what happened in Trump 1.0, and then reality set in and kind of fizzled away a little bit. It's interestingly that in Bush 2.0, we had, well, it wasn't really Bush 2.0, it was the younger Bush. We saw that there was some pickup here in animal spirits, and then it kind of fizzled away, but they stayed pretty high there for a little while. The offset has been in the NFIB Small Business Survey, the uncertainty index, and you can see that the uncertainty index was pretty high in the kind of late stages of Biden as it was uncertain, whether he was going to make it to the election. And then we got the certainty that he wasn't going to do it. Then we had Harris, and then who was going to win. It was radically different policy agendas. And now you can see we're still relatively high in the uncertainty. So maybe you could argue that whatever we gained in animal spirits, we're kind of taking back with uncertainty with regards to policy, with regards to Doge, trade, and so on. This is what Eric was mentioning before. We were talking about Walmart. The thing was selling at 38 times forward at a forward PE. That's pretty rich. And so that kind of made it vulnerable. And I guess you could argue the market's vulnerable from that perspective, but much will depend on the earnings outlook. And it's interesting that, by the way, that Buffett, in his market letter, really didn't comment much about the market at all, and kind of indirectly addressed the issue of why he's got so much cash, but didn't give anybody a clue that the reason he has a lot of cash is because there's nothing to buy, and he figures that things are overvalued. But the guy's done awfully well over the years, so we have to take that into consideration. Then, as Eric mentioned, we're not quite sure why anybody pays much attention to the consumer sentiment index anymore, but we have to respect the fact that the market did pay attention to it on Friday. And, it zigs and zags a lot, so it zagged instead of zigging, and market sold off on it. It's very sensitive to inflation, and it's got an expected inflation series there that jumped up, and you can see that's a pretty volatile series of late. And so what goes up could very well go down. We'll see how that is. But presumably this is all related to tariff talk. The media is all saying that there's going to be inflationary consequences of tariffs. And yet, this is still a work in progress. In the past, the expected inflation, the 1 year ahead in the consumer sentiment index, was relatively well correlated with gasoline, but gasoline stayed down. So again, this suggests that it's something else, and that something else obviously seems to be concerns about the inflationary consequences of tariffs. Then we had that bad retail sales report. We think it was weather related. This is what it looks like in seasonally adjusted. It took a 0.9% dive in current dollars. This is what it looks like not seasonally adjusted. It tends to come down a lot in January. The seasonals tend to adjust for that. You look at it this way, and it looks like consumers are still in an upward trend in terms of higher highs and lower lows. What else can we tell you? This is the retail sales, the Red Book retail sales series, year-over-year percent change. Not a exact correlation, but pretty good, and certainly another way to kind of offset whatever message we're getting from this retail sales report, the monthly data. And all in all, it doesn't look all that bad, certainly not on a year-over-year basis. It was kind of a funky jump in consumer credit at $40.8 billion, a 1 month increase. That was consumer credit. About, I think, half of it was consumer credit cards. It can be a volatile series every now and then. And you can see it's been especially volatile of late. It hasn't been kind of the smooth situation. So we wouldn't take this too far and conclude that consumers are stretched and being forced to stretch in order to meet their spending needs. And meanwhile, if you look at consumer credit, both total, non-revolving, revolving as credit cards relative to disposable personal income, this suggests that consumers are not doing anything really outrageously out of step with what they've done before. It looks affordable. It looks as though the burden is it can be carried. Then again, some of the alarmists are ringing the alarms that the percent of consumer credit balances that are 90 days or more delinquent. If you look at the consumer credit, these are all pretty tame here. Maybe the autos are somewhat high. The credit card numbers are also kind of high, but they're kind of consistent. We don't have a lot of history here, but we don't find this alarming, and we don't find that consumer credit has ever really predicted a recession. Obviously, if something causes a recession, having delinquencies already up before that people lose their jobs makes the recession worse. But we don't see a recession up ahead here. This is another slice and dice on the data. This is the percent transitioning into 90 plus days delinquent. So how many of these different credit items are becoming delinquent? And you can see this is relatively high. It's nothing like it was back during the great financial crisis. The autos are over here. Again, we're not alarmed, but there's other people who are ringing the alarms, and they'll do a good job to keep us on top of that number. Then, Eric, you want to tell us about Figure 14?
Sorry. Yeah, I mean, we had this drop off just below. Sorry, yeah, it was
Oh, okay. Is that
he doesn't have a
Yo-Yo over
hard
there?
time. Yeah.
What's he excited about?
I honestly don't know, but
Okay.
every once in a while, but we'll keep going.
Okay.
So yeah, we had this drop off in services PMI last month, just below 50. It's a pretty volatile series though, and it's coming off, pretty high levels. I think the ISM data, which Ed mentioned before, tends
Yeah.
to do a better job of being a little less volatile. In terms of new orders, employment, production, pretty much every subcomponent of the ISM series, it's all been high and doing pretty well. And we've been seeing the rebound on the manufacturing side. So until we get the ISM data, I wouldn't read too much into the quote unquote services slowdown.
Yeah, the bad news, the New York and the Philadelphia surveys have come out. Dallas came out this morning. Dallas was actually on the weak side, but the pricing indicator kind of confirmed what we're seeing in New York and Philadelphia, and that is kind of a slight spike here. And that's consistent with consumers worrying about higher inflation because of tariffs, and undoubtedly this is again tariff related. So there is something to be concerned about here, and that is inflation making a comeback, or at least stalling out. We're more in the stalling out camp than in making a comeback. And if it's stalling out, then we know what that means about the Fed. The Fed's on hold for the time being, for foreseeable future. This is the Buffett ratio. This tells you everything you want to know why Buffett is settling. Back here, he said when the ratio gets to around 2, he gets nervous. And well, it's well above 2. As you can see, this is the Buffett ratio is 3.12. And on a weekly basis, we can get the same ratio, and that's 3.03. Then, of course, we're not seeing any reason to get upset about the outlook for the consumer. As long as they have jobs, as long as they're not getting laid off, as long as if they get laid off, they don't have to hang around without a job for too long, the labor market looks pretty good to us. And so based on what we're seeing here with initial claims and continuing claims, the labor market looks pretty good to us. Finally, we also, when we look at the economy, we look at the forward earnings numbers as an indicator of the economy. And you can see that forward earnings, all-time record high. A slight decline here. If we wanted to scare you, we'd just box this in and magnify it. And it looks like the past couple of weeks have been weak, but it doesn't go straight up. It tends to churn around. We did see the mid caps forward earnings showing some signs of life. They also edged down a little bit, and we're still seeing a coma here in the S&P 600. So, yeah, our preference has been the S&P 500. Within that, the S&P 493, and then outside of that, the mid caps look decent to us. Small caps, not so much. And then on a global basis, we've conceded that China the obvious. China and Europe are doing better here. The fundamentals don't look much better to us, but global investors clearly are looking to diversify away from the U.S. for now. But we think it's on a kind of longer term basis. We still would recommend staying home rather than go global. Let me turn this off here. Eric, you want to field? We got some questions, so let's go for them.
Yeah. So this first one, are there any thoughts on the repeal of the Jones Act on either productivity or inflation or just broadly?
I missed it, Eric. Did you catch? Was it repealed or?
I mean, I think they're probably going to repeal it. I don't know what I don't know how big of an impact it will have. I know it leads to some funky things with specific states, especially Hawaii, like imports oil
Yeah,
from.
not everybody knows what the Jones Act. I think it means that in order to deliver oil in ports in the United States, you've got to be a U.S. vessel ship. Did I get that right?
Yeah, I think so. I think it's kind of funky. It's like a legacy of like World War One, World War Two era policy. So yeah, I mean it'll probably help to modernize that or get rid of it, but I don't know if it's a huge thing.
Yeah, I'm on the energy front. We wrote about the new LNG plant that's being built down in Louisiana, and we gave you a link to all the plants that are being built. I think that's the big story is the extent to which we're developing more and more capacity to export LNG. I was quite disturbed in our what I, you know, we in our what I am reading. There was an article I read and we read that indicated that maybe the Europeans are or should consider buying gas again from Putin, I guess, once things are settled over there. And I hope that doesn't happen. And I hope that the U.S. becomes their primary source of gas. But we'll see. Crazy world. The Germans, of course, went more to the center. We'll see how that plays out with some of their policies, which haven't worked out very well at all. Go ahead, Eric.
The next one's on small caps. Yeah, I mean the Russell 2000 is a kind of crummy index, but also as you saw in that chart we just showed, the forward earnings have just been stagnant for a few years. So
And those are the company, and the Russell has what 30, maybe 40% of their companies are losing money. The S&P 600 don't have that problem, or very few of them have that problem.
mhm.
So this is what profitable companies are doing, which isn't very much.
Ed, can you speak to the change in currencies and the outlook for overseas markets?
Eric, why don't you take it? I guess I'm not sure what they mean by changing currencies. I mean that the dollar's been weak of late, or you
I mean,
interpret it
I can take it. Yeah, the dollar broadly has been doing pretty well, but mostly against EM, the Canadian dollar, the peso, and then meanwhile the yen is really strong right now, and the euro is doing a bit better. I mean, Europe has some catalysts, and their stock market is showing that too, right? If you get an end to the war or more secure energy, um, and or like the political scene, which was it's highly uncertain, right? If there was an uncertainty index for Europe, like the EU, it would be pretty high. Um,
right?
that's probably like all those things look a little better now. So the euro is doing pretty well, and Japanese inflation and growth. So Japanese nominal growth has been really good, which is a good thing. It's why Japanese stocks have been doing pretty well. But it raises the issue of is the BOJ going to continue to hike in what's pretty much a global easing regime? So it makes sense that you're getting some strength in the yen there. I don't think there's like some sort of carry trade unwind part two coming. I think they'd rather avoid that. But yeah, the dollar's held up pretty well, all things considered. So that's kind of how we're seeing things.
Yeah. Well, I hope the yen doesn't get too much stronger because my wife and I are going to go to do a little tour of Japan, South Korea, and Taiwan at the end of March, early April. So let's not root for it to be too strong here, but it's got a lot of going for it. Inflation's hotter, the economy's stronger, and I don't think they're too worried about the carry trade issue. I think that's kind of been washed out. Okay, why don't we take two more questions, Eric?
Sure. So, hi Ed. Services seems to be cooling off lately. At the same time, we're getting a rebound in the manufacturing sector despite potential tariff risk. Can this rolling recovery theme kind of save the day, even if there's a slowdown on the services side? And how much, if the services sector continues to slow, can that really weigh on the stock market to a significant degree?
Yeah, well, again, we're kind of skeptical that the service economy is slowing. We're not big fans of the S&P global NMPMI, so we'll wait to see what the ISM NMPMI does. It's just hard to believe that the services economy is slowing for any particular reason. I mean, certainly anything related to what retiring baby boomers spend on, which is going out to meals, traveling, doing cruise ships, going to see their medical providers. I can't imagine that any of that is slowing down. Uh, but to take your point, I mean, if the services economy really is slowing down, contrary to our feelings, and manufacturing's picking up, manufacturing is still pretty small compared to services. So it's still net would give you a slower economy. Maybe something like what Steve Cohen recently said that he thought the economy was going to slow from 2.5 to 1.5%. I don't know what it is about these billionaires who walk around telling us to be pessimistic. Ray Dalio seems to do the same thing, but I don't know. We're not feeling that pessimistic about the consumer services, and now we're seeing some signs that manufacturing, after being in a funk since mid 2022, I would say late 2022, is picking up. You want to? I think Willem had two questions, one and then one after that.
Yeah, the second one was on the Jones Act and
Okay.
what you said about US ships. But Willem asked, so few or Trump 2.0 has had few significant economic decisions, and the main channel through which private markets and economic activity will be affected for the time being is via uncertainty. So I guess what are we seeing in some of the key uncertainty indexes, or just broadly in terms of market uncertainty?
Yeah, I mean, we showed a uncertainty index that we have from the National Federation of Independent Survey of Small Businesses, and it's clearly up. But at the same time, the other animal spirits indicators of look pretty good. I think there was one indicator on capital spending that's very, very volatile that went down. But other than that, I think this was a January survey, so it looked on balance okay, except for the uncertainty. And I don't know. I think so there's always uncertainty, and there's always uncertainty coming out of Washington, D.C. I don't know that any of this is really going to hold people back. Maybe on the tariff side there'll be some issues, but already it seems that Apple basically said, well, to the administration, we hear you, because they're spending $500 billion on building a big plant in Houston. They said they're going to be hiring 20,000, and they also said that they pay a lot of taxes. So everybody seems to be putting some money in the pot to show their good faith or their support for Trump's America First policy of, if you have a choice to build a plant in the U.S. or overseas, we would hope very strongly that you would make the choice to build it here. And so I don't know. Eric, are you uncertain? Are you changing any of your any of your plans?
Yeah, no, I mean, there's been also some CEO confidence indexes, which are pretty high right now from Business Roundtable and elsewhere. So, I mean, I think the bond market is frankly one of the big uncertainty indexes, quote unquote, that a lot of people would be watching, but yields have been coming down and volatility is lower. So I think and if we're kind of concerned about the fiscal deficit and tax cuts and what that's all going to do, I think that's one of your biggest signs. It's also financing costs for a lot of
Yeah,
companies, but it's a
let's
good
just
time.
yeah, let's just wrap it up. There's another question here about the weekly hours as being a leading indicator of the economy, and it's been down in the past couple of months. We think it's again weather related. We think it'll and also fire related. We think it'll bounce right back in February, so we're not particularly troubled by that. So that's our story. Thanks for joining us, and we'll see you again next week. I think Eric, you won't be here, right?
Yeah, I'll
You'll
be
be
in
on vacation. Yeah, you're doing on a vacation, and then Jackie Dougherty is doing a vacation. Then I'm doing a vacation, but we'll keep on producing. So thanks, everybody. We'll see you. I'll see you next week.
Thanks, everyone.